Real estate agents, welcome to the Weekly Closer. I'm your host, Jeff Underwood, along with my co-host, Joey Sampaga. Preacher Man. How you doing, Preacher Man?
What's up? How you doing?
You know, staying in.
I'm excited about this one.
Yeah. Hey, we are the Real Estate Marketing Maniacs.
Ooh, yeah.
And the show, don't forget the show is brought to you by Security Title Agency and Fidelity National Home Warranty.
Yeah.
Got an exciting guest with us today in the house. We've got Tina Tamboer with the Crawford Report. How you doing, Tina?
Tina.
I'm doing great. How are you?
Fantastic.
Lots to do.
Oh, yeah.
You're busy.
Lots to do.
I see you on Zoom everywhere.
Oh my gosh. I'm Zooming my life. I've never had so much more of my life recorded in my whole life. It keeps
you're
going.
like a local celebrity now, right?
Yes.
I'm the nerds. We come out of our caves around this time. And then when everything gets back to normal, people forget about us again, and it's fine.
When things are going great, everybody's happy.
When it's exciting or when it's boring.
Yeah. That's funny. Well, we've got an interesting show, agents. If you're listening, watching, we're actually going to go over some of the headlines that are out there right now, and we're going to talk through those. Tina's going to shed some light on some of these that maybe are overreacting a little or a lot, and just kind of give you her perspective to what's happening with the housing market, especially here local, and what kind of impact some of these things that we're going to discuss might have on it. So, Tina, are you ready to rock and roll?
Anytime.
All right, cool. So some of the headlines here come from different sources, some from CCN, not to be confused with CNN, please.
Right.
CCN. And then we have some from Forbes, Yahoo Finance. But let's start with some of the ones that come from this source called CCN. One of their headlines is titled, "Realtors, housing market crash will last long after coronavirus is gone." Whoa.
I know.
That's kind of scary. Is that scary? Oh, I wish I had a doom and gloom button on my, anyway.
I know. We need a wah wah.
Yeah,
after that.
Exactly. So one of the things they mentioned, Tina, I know that you've looked through this as well, but they were talking about the stock market. Of course, we've seen the stock market take a dive earlier, right? Back in March. It's regained, I don't know, what maybe half of what it lost, I think, back then.
Yeah, I try not to look.
Yeah, so, but let's talk a little bit about how does the stock market during these times differ from the housing market?
Well, the stock market, for one, moves way faster than the housing market does. And mainly because of the quickness of the sale. So the minute you hit a button online, you've sold your stocks and the price is recorded, and they can immediately throughout the day tell you whether or not prices are going up or down. It's just not like that in housing. When the market slows down, the irony is you have to wait 3 to 6 months for that to actually record and see how prices are responding. So there are some indicators that we can look at, but for the most part, you have to wait for the properties that are active today to get a contract sometime in the future during this time, and then you have to see the prices record, and then you get to see how the prices responded. But that won't happen. We won't actually start to see that until about 4 to 6 weeks after the slowdown in contracts and things like that. And that's assuming that your escrow is 4 to 6 weeks. Now, some of these escrows, lenders are asking for a little more time. So they could be up to 2 months after. And that's not even counting your marketing time. That's just from the time you get a contract. So A, housing doesn't work that way. B, not everybody looks at their 401k performance before deciding to buy a house. It has more to do with their job, how comfortable they are, their savings, things like that. But there are markets that do respond right away. And one of the markets is luxury. So if you imagine a luxury buyer is going to rely on their portfolio, their corporate profits, even things like international exchange rates, and also their physical ability to get here to buy that second home or, relocate here. So that has taken a big hit. And any kind of Wall Street backed investor, those are going to be hit by the stock market, and they'll be affected right away. But as far as individual markets go, it really depends on how much of that you have in your marketplace as to how your housing is going to respond. And housing doesn't always respond to it. We've had market crashes where housing's done nothing in terms of price. And we've had crashes where housing was why it crashed. But housing doesn't necessarily crash because of the stock market, but the stock market can crash because of housing.
Yeah. So do you see a lot of real estate agents, whether it's local or national, that are, I guess, sharing this type of message right now? Or is everybody pretty positive? Or are you seeing some people? I know it was talking about, realtors warning of what the coronavirus will cause as far as the housing crash potentially. Mm-hmm. But what are you seeing in the marketplace?
I think that we have a lot of realtors with PTSD still from the crash of a decade ago. And so it's very difficult to take those feelings and put them aside and look at what the numbers are telling us today and how they're different today versus then. But you're seeing a lot of those same fears come out. And some of these headlines that we see are kind of in a way, a clickbait. I mean, because somebody's going to click on that to see if, oh my gosh, is this another one? Am I going to deal with this again? And so they get the eyeballs on them the more dramatic your headline is. But they don't always tell you that it may or may not be affecting you. Some of these headlines aren't even talking about who you think they'd be talking about. They're not talking about you and me, regular homeowners with mortgages necessarily. They're talking about investors. They're talking about vacation rental owners. They're talking about, some people who've lost their job. Yeah. They're talking about all kinds of different things, but there's so much different about this situation than the crash of 2008. The crash of 2008 was years in the making. This was weeks in the making. It's totally different.
Now, you just mentioned unemployment, and as we're recording this morning, I think the numbers came out. The claim numbers, unemployment numbers. So we're now just above 30 million. Now, I know you and I talked about this last week a little bit about the possibility or probability, if you will, of people that couldn't normally apply, right, for Social Security or put in a claim that are able to now. So self-employed, independent contractors, those types of people, right?
Right.
So is your feeling that a decent percentage of these 30 million are probably from that group?
I think so.
I know there's no simple way to tell, but.
Yeah, well, and unemployment anywhere is kind of fuzzy. They base a lot of their stats on polling. They call people and are like, do you currently have a job? Have you lost your job in the last 2 weeks? Are you looking for a job? If somebody offered you a job today, would you be available? Blah, blah, blah. They have a big old long list of questions they ask people. So the employment report we got for just Greater Phoenix, I don't track the nation so much, but I can tell you that what's different today is you've got people who are self-employed, 1099, independent contractors who never would have even called to see if they qualified for unemployment. Now, not only is your unemployment higher than the $240 a week, okay? Normally in Arizona, you'd get $240 a week. Not exactly enough to live on, but enough to help you out so you can get through a period of time and, live off savings a little bit, get a job. And you want a job after. That's not enough, right? But now you've got a federal overlay on that where they're adding another flat $600 a week to that. So now your unemployment's like $840 a week. That's almost $43,000 a year. And if you're self-employed, you're like, heck yeah, I'd ask about that. Who wouldn't ask? So a lot of these numbers that are coming out are just people who have inquired about it. And it's skyrocketed. I mean, that's a huge amount of money compared to what people used to get or expect. And also now you've increased the number of people who would even qualify for it. So I don't find that overly surprising. But here's the thing. In certain professions, that's still not that much, right? Yeah. So say, for instance, you're in real estate or you're an opera singer or you're in, maybe you're one of those bartenders that makes like over six figures. I mean, some people, that's not really going to be a lot. So the minute they get back to work, being self-employed, they're not going to be taking that if they were even eligible for it in the first place.
Yeah.
And if you are making any money at all, you're not eligible. That's the thing with unemployment. It's all or nothing. So if you're already getting, say, I don't know, $500 a week for some side gig that you have, you're not going to qualify at all. But of course, you're going to call to see if you qualify. You know what I'm saying? And the thing,
I would think that, I don't know the number for sure, but I mean, not to ruffle any feathers with real estate agents that are listening, but I mean, facts are what they are. I think the average real estate agent across the country probably makes less than that 43,000 a year, potentially.
Yeah,
so,
that's true.
And here in the Valley, I think the bottom half maybe do.
Well,
20,
yeah,
I mean,
because
I'm not trying to be mean. I'm just saying that there's a lot of people that fall into that category.
Yes, and not everybody in real estate is full time.
Right.
Okay, so that is well known. And so if you were never full time anyway, are you going to qualify for unemployment? So again, the idea that people are just calling to see, that's a whole different number than the people who are actually getting it. And when we look at the actual numbers of jobs, not self-employed, but W-2 jobs, the biggest hit industry here is leisure and hospitality, which is your entertainment, your musicians, your hotel, restaurant, and also professional services, specifically custodians, people who pick up the trash in the offices, you know, where people are now staying home. So there are these industries that are being hit more than others. And the question is on housing. Okay, I'm not saying this is a great situation. It's not, sucks. But how many of them own a house and won't be able to make their mortgage payment? How many of them are all by themselves owning a house and can't make their mortgage payment? How many of them have another spouse that might be in the same industry? Kind of things like that. Those are numbers we don't actually know.
Yeah.
But the fact is that that's the industry that's mostly affected, way more than any other industry. And there are also diversifying activities that have been happening over the last decade in Greater Phoenix, and diversifying the work base in terms of industries coming here, like trade, transportation, and utilities. We're actually hiring at the same time that the layoffs and furloughs were happening. And that's another question is, you know, how many of these guys are furloughed? You know, where they will have a job waiting for them and they can choose. So for instance, I'll just take my niece. She's in hotels. She's in accounting. She was furloughed. She can get a job in accounting anywhere. There's already somebody who actually hired her full time to do their accounting until her job comes back. So yeah, she's part of the numbers. Is she taking unemployment yet? No. But guess what? That person had to pay her more than $840 a week.
Right. Right. Absolutely.
You know what I'm saying? It's like it's just a completely different scenario that when you think about it, it's like, wow, this
absolutely. I'm part of some financial coaching groups on Facebook, and some of the posts that I've seen lately are these either financial advisors or coaches that are posting that they've got clients, mostly coaches side, clients that are getting the unemployment right now, the max basically, right? And are questioning, should I even look for a job? Or, and some of them have responded with, they're telling me that they just want to go ahead and get the unemployment since it's more than what they were making before.
So, and that is the key. That's the difference. That is the difference between now and the past. And of course, the stigma of taking unemployment is not there right now. And so, and I just feel that in this situation, this number of unemployment and the recovery rates, you cannot project based on this. This is now, if they change their regulations around it, then we might see a change in people's activities. And how they get through this.
Yeah. And I wanted to go into the unemployment part of it because that next headline, also from CCN, was the U.S. housing market bubble is bursting, a sales plunge. And one of the points they made in there is of course, the massive unemployment number that's expected or that is growing.
Well, what's also interesting about $840 a week is many people can afford their mortgage payment on $840 a week. And so how does that affect housing? Well, it affects housing in the sense that if you've got a tenant and they are taking this unemployment, then they can make their rent payment. They can make their mortgage payment.
Yeah.
And so if, as surprising as it is, in fact, for housing, it's not such a bad thing.
Right.
There might be other issues that we all have with it, and worries and questions, but overall, it means that people can make their mortgage payment. And it stabilizes the housing market. It doesn't throw it into a crash.
Yeah. And just so you know, agents, I love you all out there. We were just talking.
We're just talking.
Yeah,
it's just information.
So, exactly. Okay, so let's move on to the next topic. And this is one that I've seen a couple people do videos on YouTube about, and kind of the concern around Airbnb and kind of what's going on there. With a lot of people, some of these investors might have multiple houses that have been sitting vacant now for 45 days. What are you seeing here in Phoenix, or hearing, or, what do you think is going on with that whole segment of the marketplace?
Yes, the article that referenced vacation rentals was from Forbes, and it was a guy. His name is Jesse Colombo, and he in 2008, at 22 years old, this guy predicted the bubble. And actually, I think he's got a good point. And as an analyst too, I've often worried about the vacation rental industry, frankly, as a red flag. And I think he's spot on with the potential of creating bubbles with this particular industry. And the reason I say that is that false demand was one of the things that led up to our bubble, which means false demand is somebody who's buying the home and has no intention of living in it and has no intention of putting a renter in it. That means that home is now taken completely out of housing supply. And the person they want to put in it is a tourist. And all of us, as we're experiencing now, and we have in the past, we know tourism can drop in a day. Tourism just doesn't gradually go down. Tourism stops, and so that's a big risk factor, because when that happens and you can't put a tourist in your home, you take it out of essentially hotel supply, right? And you place it back into housing supply. And one of the whole reasons tourism would go down in the first place is because of a crisis, of either a recession or something that would cause buyers' real demand not to be there. I think that we kind of dodged a bullet, frankly. Luckily for us in Greater Phoenix, we still have enough demand to put renters in those homes right now, or even to purchase those homes, because our supply was so low. But it's more of a red flag in those areas that are very popular. So areas like South Scottsdale, downtown Phoenix, lots of parts of Scottsdale and in other areas of the valley that tourists like to go to. But also when you look at the small towns like Sedona, Flag, Show Low, where they were literally building supply for tourists, but it was marked as they're building condos and townhouses just for tourists. That is a big problem, because if you push the population out of an area because the prices go up, when you take those homes out of supply, when you still have a lot of demand for it, the prices go up, and they go up exponentially. And so the question is, when they go vacant, will you have the demand, and what will happen to prices? So actually that is probably the most valid argument for a bubble. But the good news for us is that in our area, it hadn't proliferated to the point where it would cause, all of that supply going in the market would cause an actual crash.
So if I live in a nice neighborhood in Scottsdale that has quite a few of these, should there be concern there, or is it? You think we're going to make it through?
hopefully
guess it
they
depends
have.
on their timeline, of course, but
Well, I would imagine that in some of the nice areas, they've found quite a few homes going up for long-term rents or for sale. And or if the owner was well off enough, they might have just taken it off all of now. Very few, mind you, very few vacation rental investors are not leveraged. So they have a certain amount of leverage. They still have to pay the HOA fees. They still have to pay their taxes. They still have to pay all kinds of things. So I would imagine that most of them are being converted either to long-term rentals or properties for sale right now. And if they are low enough in price, then they're going to be absorbed, and that's fine. But if you're in a luxury area, especially if they're over 700, which, mind you, that lending, jumbo lending, requires portfolios, and the portfolios are part of Wall Street crash. And so lending over 700,000 is in Greater Phoenix is dead as a doornail. And so I would be worried if the overall values in your neighborhood are over 700 and they have to sell. But again, I would believe the last number I saw, the issue is we don't have numbers on Airbnbs and VRBOs because they're not regulated. And when they're not regulated, nobody keeps any data on them. And so we don't know how many there were. We don't know what the risk is by area. But I would imagine that many of the vacation rentals in the more expensive areas, hopefully those owners are in a position where they can weather the storm. But
yeah. Okay. And there's another, one of the other articles from CCN also mentions that, I believe, too. The Moody's mortgage meltdown warning rings 30% default doom scenario. How about that?
Yes, they are also talking about vacation rental landlords in terms of defaulting and the doom. So where they're referring to is back in the day, back during the 2008 crash, one of the big things people remembered was the foreclosure crisis, and which started with a massive amount of investors walking away from their properties. The big difference today is that prior to the crash of 2008, the investors that walked away from their mortgages had no money of their own in them. They didn't put down payments down because they were using 110% financing. All of the money was the lender's money.
Yeah.
And so because they had very little of their own money in there and they had no equity, they just walked away from it. It was a business decision. But that's not the case now. Lending's been draconian compared to what it was in 05, and 06. And so lending now, over the last decade, has required a pretty significant down payment. Even though some of these guys may be, leveraged, they have a lot of equity in there. And I don't know that they're just going to walk away from their equity. They could sell it just regular. They don't have to go through a foreclosure. They'll probably take a loss, right? But they've made their money. They made a lot of their money on these properties already over the years. And so I wouldn't feel too sorry for them.
Yeah.
Only the new ones. New ones I feel bad for. But the fact is that they have equity. So I would be very surprised to see a high level of foreclosures at this point when they could sell it.
Got it. Do you think that the forbearance, what they're allowing right now for people to just say, I want to go into forbearance, right?
Mm-hmm.
What kind of impact do you think that might have down the road? I know that wasn't on the thing here, but while we were talking about foreclosures, I'm just thinking, well, there's a lot. I don't know what the number is now of how many people have put through for that forbearance on mortgage payment. But
I think it's going to be a ding. I know they're saying that it won't hit their record, but it will be on their record. So even if it doesn't affect your credit score, there's going to be a notation on your record somewhere. They don't just forget that stuff.
Yeah.
And it may affect people's ability to refinance, even though it doesn't affect the score. So that's where I think some people have to make a real informed decision for themselves as to whether or not they want to do that.
Right.
But I think that the forbearance issue is going to be, there are going to be some options for sellers. They there are some people that say this is where we're going to see the big foreclosure crisis, is like they're not going to be able to make this big payment at the end, but they're already making changes in the lending process. That by the time we have to deal with that, they might have a whole system to deal with this number of people. So
Sure.
I would say it's probably not a good time. It's a little too early to be predicting another foreclosure crisis off of the forbearance issue, especially since we have such support for sellers. We didn't have this in 2008. Lenders didn't want to talk to sellers who couldn't make their mortgage payment.
Right.
We certainly didn't have the level of government support either on this scale that we have it today to help people stay in their homes. Not to mention, you've got, again, sellers have all kinds of options. If you're a landlord, you reduce the rent. It's amazing what you'll get when you reduce the rent. People will move in with each other. What you see is households consolidate. So there are a lot of different things in it, but again, the real estate market moves really slowly. Things could completely change and we may not see anything. Because it really depends on how the industry responds. And the real estate industry, I would say, is probably one of the most creative, most fast-moving, and adaptable industries I know to this stuff, because this is our world. We deal with this all day long, changes in real estate, right? It's like we move like that.
Right. Absolutely. Do you think any of the changes in the lending world right now, for example, higher credit scores, more down payment, lack of low down payment options, I guess you could say. Do you see that impacting us local here at all, or?
Yeah, it'll impact us, but not how people think. Let me tell you, tight lending practices do not cause housing crashes. Loose lending practices cause housing crashes. And frankly, they were trying to get looser in the fourth quarter of last year. Remember, the lenders were really pushing they were waiving appraisals. They had raised the loan limit to 510 for conventional. They were pushing on these debt to income ratios that the big banks, not Fannie and Freddie, but the bigger banks were restricted from lending to people with high debt to income ratios. And so they were actually pushing the government to allow them to loan to people with higher debt. That's what causes price bubbles. That's what causes demand to go up and prices to go beyond what the wage increases can keep up with. But tight lending practices actually are good for the housing market. They keep it stable, meaning that anybody who buys today can weather this storm. You wouldn't be able to get a loan today if you couldn't weather a little bit of this coronavirus going on. So good, solid buyers will get loans in this market. Yeah, we might start to see a bit of a drop in the volume, but again, most people are expecting this to be temporary. This is a temporary pinching of the hose, if you will. We've just kind of paused the market, and these loan practices could loosen up as fast as they went tight.
Yeah. So when I look at some of those, even anytime I see programs that allow a 50% DTI or 55% debt to income ratio, I'm like, what is going on? And it seemed like that was fairly common the last half of last year. But to push those ratios that high, I think personally, with my financial planning studies that I'm in, anything over 36% for our association is the max. But we don't see that. We don't see that at all. Not a lot of people are sticking to that type of a ratio. So when I see these 45%, I think 45 is way over as well, but 45 and 50, I think that is pretty loose.
Yeah. So I am less concerned about lending getting tight. I was getting more concerned with how they were getting loose prior to this whole thing. And I wasn't sure what was going to stop the increase in demand fueled by that, which by the way, that is not about you and me. It's about investors taking advantage and investors taking on a little more risk in their portfolios. That's what causes me, to have a little more like, what's that about? Like, that's not good. And so I wasn't sure what was going to stop that until the wrecking ball came through with the coronavirus. That was probably the act of nature was probably the only thing that saved us and kind of smacked everybody upside the head a little bit and been like, what are you doing?
Right. Well, with the So with tightening the lending standards, I think that's a good idea as well. Of course, that takes some buyers out of the market, right?
Mhm.
And with the fact that, we have all-time high household debt again. The stock market was at an all-time high, and then housing market at an all-time high on a national level as far as the median price. Do you think there's something more to happen, whether it's a year down the road, 2 years, 5 years? I mean, I know you can't predict anything, but I mean, just the state of, I guess, the financial position of many people in our society and kind of where we are. What are your thoughts?
Well, I think
I threw that one at you. That was a curveball.
This
Sorry.
is just my opinion, not really based on any numbers, obviously, at this point. So my opinions are always free. But I think that as a society, we have really had a good idea of our opinions about debt had gotten pretty loose. And now we're seeing why debt may not be as great a thing. And for the overall health of the economy.
Yeah.
It's always good to have people who are solid, have a solid base, and to quote a song that there's a song that's out there right now, and it says something like the house don't fall when the foundation's strong. And so when you have a strong foundation of good, responsible lending practices, people who have a solid base for employment, areas with solid, diversified employment. So when one industry goes down, another industry is going up at the same time.
Yeah.
Just kind of balance out and hedge our risks, where our risk of the tourism industry, which has always been a risk in any area that's high in tourism.
Right.
You want to hedge that with other industries that don't follow the same roller coaster. Like that. And I think we've done a very good job of that in Greater Phoenix, and I think it is helping us out right now. And also that good base of equity for individual homeowners right now.
Yeah.
Long-term.
Sorry, I didn't mean to throw you a curveball. I was just throwing it out there. Just lobbing it out there.
I think our attitudes, I mean, you and I are probably quite conservative both on our thoughts about debt. I'm not a huge fan of it. But I have noticed that some people don't find that is a big deal. Like, I think it's a big deal that you have 8 years on your car loan. I mean, I find it's a big deal that you have a loan on your phone. Like,
there you go.
You know what I mean?
That's right.
I mean, we have a loan on our phone.
Yeah.
I didn't have that in 2005.
Was that a country song that you just quoted?
No.
I think it was a country song.
No, it's kind of it's a love song, actually.
Okay. I was thinking there are probably a lot of mortgage people out there singing that Heart song right now.
I'll send it to you. All right. That's a good one. You can even play it. Maybe you can stick it into your video.
Got it. I heard some mortgage guys out on the corner the other day singing a song too. It's from Heart. It's called "How Do I Get You a Loan?"
And see, now that's the key. It is, frankly, what people forget is that banks want to make loans. So the thing is, banks are going to do what they can to ensure that they can make loans in the future. And so that's why many people don't feel that this is a permanent thing. But there are things that are reasonable to expect, and there are things that are not reasonable to expect. It's reasonable to expect that we're going to have a little mini recession. That's
right.
Reasonable. It's not reasonable to expect we're going to have a housing crash right now. The numbers don't support it. They just don't. Our supply and demand is nowhere near where it needs to be to justify a crash. And so, and for somebody to say housing is crashing and then predict a 5% drop that's hilarious.
Yeah.
That's not a crash. That's like, just hold on to your house for another year.
Yeah.
Yep,
that's right. Joey actually laughed at that last one, didn't he? I thought I heard Joey come on there for a second.
Yeah, like people who think 5% is a crash don't know from crashing. What they're talking about in crashing is the volume, the number of sales being closed every month.
Right.
And again, that sales volume and sale price don't always correspond with each other. You can have a drop in demand and also have a drop in supply at the same time, and prices do nothing.
Yeah.
It's all about what your supply is doing in relation to that demand. You can't You can't take 50% of your equation and predict what's going to happen with price.
Right.
But you can predict when you see demand go below normal levels, which is what we have. They're about 15% below where they should be now. You can expect to have a lower number of sales. But here's the key, and this is what's being reported now, is the big surprise is that mortgage applications increased.
Yeah.
12% over the nation, but specifically in Phoenix, the number of contracts accepted last week bumped up 20%. So apparently the only people reading the headlines are us.
Yeah. No, that's definitely a comeback right there. So
yeah.
So Jeff, I'm curious before we move on. I mean, sometimes I listen to you speak, and you sometimes think that, you know what, it has to crash here pretty soon. I mean, am I mishearing you?
No, my thoughts are there always is a correction. There's always a correction on the horizon. And so my thoughts are, at some point, we have to see that correction. I mean, we've seen asset prices inflate over the last decade again, historically low interest rates. I mean, I think that's been the saving grace, has been the fact that the rates have been so low that people can afford the payment. So at some point, I feel like there has to be a turnaround. There has to be some inflation. There has to be some money being made in our savings accounts and in CDs and other places, or we're just stuck. We'll just be in this this rut for way too long. So I personally feel like whether it's 6 months or 5 years, that's the thing. Nobody knows, but there normally is going to be some type of correction that's coming. So,
and here's what I say about that. I don't think corrections come just because it's time. I think that there's definitely a lead up, and there are some red flags that would lead me to think that something's going to go on. And so I'll tell you what my red flag is. Whenever Wall Street gets involved in residential real estate, they always screw it up. That is my opinion. They screwed up mortgage lending when they started messing around with it in 2004 and 5, and they get really risky because Wall Street is risky. Does that make sense? So they started securitizing these loans. That was what led up to that. So then that had the big kibosh, obviously. And now guess where they got involved last year, and actually a few years prior, but specifically last year, Wall Street got very involved in flip investing, in your iBuyers.
with the iBuyers, yeah.
Yes, they started funding. Some of these iBuyers are around anyway. We always have flip investors around. But the minute you get a bunch of Wall Street money, then it messes it all up. Does that make sense? Because now flip investors aren't flipping with their own money. They're flipping with somebody else's money. So guess how risky they get on that? And we were already starting to see the effects of that. And not only that, but also in the vacation rental industry. It's not, I would not underestimate the impact that Wall Street money has on residential real estate when they get involved, because now we're seeing when Wall Street crashes, we're seeing all of the areas that they had their fingers in there. And the good news is, in the areas that had plenty of demand from regular people, and we are still in affordability, that's the big key, we have enough demand and a more stable base to actually pick up those pieces now. Back in 2008, the affordability index was 27%, which meant that a family making the median income in 2008 could only, 2006, which was the peak of price, could only afford 27% of what was selling. So when the investors pulled out, there was nobody there to pick up the pieces. They didn't make enough money. The prices were way too high. But today, now that the investors have pulled out once again because of the big cannonball that came through unexpectedly, our affordability index is 65%. So a family making the median income of $73,000 a year could afford 65% of what sold in the fourth quarter. Now, I think we were on the precipice of getting into an unaffordable state, but because of this event, we actually have enough people who can pick up the pieces.
But does that, so if we were on the precipice, do you think that when we get back to business as usual, that
And, well,
we continue to build up on that to where it becomes an issue?
Can define usual, because we haven't really been in a usual situation for about, I can't remember the last normal market we've had. We've been in a seller market for 10 years. Before that, we were in a massive crash. And before that, we were in a bubble. So the last
I don't think
normal
we've been in
market
a
we
normal
actually
market
had
since I
was
bought my first
2001
house in
to
2001.
2003. If we had a normal market today, you'd think it was a buyer market, because we've been going 200 miles an hour for so long that you slow down to 100. You're still speeding, but you feel like you're in the slow lane.
Yeah.
But I think that if we, and when I say we, I mean as community, as leaders, as legislators, all of that, continue to promote incentives for individual home ownership, whether that be like an individual landlord who's got a long-term rental, but houses for people to live in. Those types of investments. And what we started to see is hedge funds out of Wall Street were buying long-term holds. And I'll tell you what worries me about that is that when you have a Wall Street hedge fund that buys a home, what are the chances that that home is ever going to be released back into the community for an individual to buy? So again, I don't know that we can control it, because we're definitely a very we're capitalistic society, and I'm not against capitalism at all. I'm just looking at what benefits society, and home ownership is the one forced savings account that we have. When you think about it, at retirement, for the vast majority of United States citizens, at retirement, at the end of their working life, the majority of the wealth they have is in the home they live in. And that's just a fact.
Yeah. Well, and a lot of that's because they haven't participated in any other investments either.
Exactly. That's what I'm saying. They buy the house, they pay that payment over the course of their life. If they don't make any other, real significant increases in, say, 401ks and everything, the vast majority of our retirees have their wealth in real estate, because that payment has forced them to build that equity over time. Right.
And so iBuyers, I mean, nobody's active right now, right?
There's still some active. They just weren't backed by Wall Street. So there are still flip investors out there. There are even some large.
I mean, the big names, though, like the Zillow and the Open Door.
Yeah, Zillow, Open Door, and
Redfin now, I believe, stopped theirs too. But
they may still have a little bit of activity going on, but the vast push of their influence has definitely retreated quite a bit. And I'm not saying they won't ever come back. They probably will at some point. This is a opportunity for other buyers who might want to pick those up now. So I think a lot of people are taking advantage of the environment where they're not dealing with as many cash buyers pushing prices up, and they might even get a concession in there in this market. So I think that's probably what we're seeing. A lot of people just don't want to put their home purchase plans on,
Yeah. I've talked to some of these other cash buyer investors, not the big names, but like, local people, right? That, and a couple of them that I've talked to over the last couple of weeks actually have really slowed down what they're willing to buy as well.
Yes.
The numbers have come way down on what they're willing to do. And they're being especially picky about the houses. So we've seen them definitely slow down what they're willing to do as well.
Well, they're being very smart, and that's what they do. That's investors. When things get risky, they get tight. And so right now, they're looking at longer hold times. You buy a house during a pandemic, and you don't know how long the furloughs are going to go. You don't know how long the stay-at-home orders are going to go.
Right.
And it's harder to sell. And, that's the thing with flip investing. Holding time is a big deal. And you don't want to have a long holding time. You want to be able to reno the house and unload it as fast as you can and get on to the next one. So right now, of course, they're going to be picky. They want something that's going to be right in the sweet spot price range. They want it to be in a sweet spot area that's already still up frenzy despite this stay-at-home orders and such. And so, I don't blame them. But here's the difference. Nobody was doing this in 2008. So the fact that we even have them considering to buy a house means that we're still in a seller's market. You know, they weren't anywhere close to buying anything. Nobody wants to buy when prices are going down. So the fact is that if you still have investors calling you up to buy your house, just that very act by itself means that we're still on a seller's market.
Yeah. And Joey, to answer your question, do I see a housing correction? I do, but I don't know how soon.
Yeah, well, a broken clock is right twice a day, so.
I will say,
I love you, brother.
So my feelings about it is there are things outside of our local economy that are going to have a bigger impact on the housing market as a whole. Yeah. Whether that's, again, 6 months or 2 years down the road, I don't know. I just think that there's some bigger factors at play when it comes to what's going to happen to housing going forward. So, I think it depends on how long this whole coronavirus thing's, lasts, how many people really are truly unemployed, how many people don't have a job even waiting for them when they get back, how many companies are going to realize they can streamline to where they don't need as many employees. I don't know. I mean, and then just the psychological aspect of it. I mean, depending on what happens with the stock market going forward, psychologically, I think Robert Shiller says this a lot, that psychology is stronger than the economy itself.
Yes. I've
enough
heard
people
you say
believe
that.
it's happening.
Yeah. If you believe it enough, it will it to happen type of thing. I didn't know he was so into The Secret, but
I think he wrote it. I think it was in his book, Irrational Exuberance.
Yes, that's his book. He, and I was watching him as he did a lot of interviews throughout last year about it. But here's the thing. I think it's reasonable to expect certain things. And when we see correction, this is what I think we're going to see. We're going to see the average dollar per square foot come down. It's not going to be because of a massive amount of price reductions. We're not seeing that. We're not seeing sellers reduce their price. What we are seeing is sellers removing their home in the upper ranges from the market. So if you have fewer buyers in luxury and fewer listings even for them to look at, you could potentially see that market stay stable in price, but because there are fewer of them, you'll see your average come down. And people will see that as a correction. And what it really is a certain segment of the market retreating and will possibly come back at a later date. It's also reasonable to expect a recession, some form of recession. Now, say, for instance, property values fall 5%, whatever, just like that person says. I don't do those types of predictions at this point. But say that happens down the line. That's why home ownership is a long-term investment. If you owned your home in 1999 and you still own it today, you are well ahead of the curve. You've probably made at least 90% of an increase in your property values at this point. That's despite the bubble and the crash and everything in between. So the fact is, you hold on to a home long enough, that mitigates your risk. But if you're buying and selling based on what you think the market's going to do, you're going to find yourself probably always buying at the wrong time and selling at the wrong time. There are analytics that we use to let you know when a good time is to buy and when a good time is to sell. And let me tell you, by the time you reach the peak of price, that is not time to sell. That's a buyer's market, and that's terrible time to sell because there are no buyers there. You always want to be buying and selling. You want to be doing everything in the seller's market. And the irony of the greater Phoenix marketplace is, despite the massive drop in demand over this stay-at-home order and everything, we are still in a seller's market. It would take a lot more than this 2 months of pandemic to pull our market into a balanced state. Now it's heading there, but it's again, it's going to take a bit. It's probably going to take at least 4 more weeks, and a lot can happen in 4 more weeks,
Absolutely.
So we just have to watch it.
How about on the rental side? Are you seeing rents get squeezed down at all? You're starting to?
No, we're not. And that's really another interesting piece. So we thought, okay, so these Airbnbs are now going into rental supply. Our rental supply went up. The last I checked, it was up like over 20% in a month. in a month and a half, something like that, 23% in there. And we were expecting to see some kind of competition in landlords and getting those rents down. But you know what's interesting about Airbnbs and VRBOs, when they go up for rent, guess where they are? Really popular areas. And they're in good shape. They've been cleaned once a week and they're furnished. So they charge more. So the irony of the whole thing is we haven't actually seen rents do anything. They haven't gone up, they haven't gone down. In fact, they've been stable at about $1 a foot for a year. And so that's been the big interesting thing, because rentals would typically respond faster than the sales numbers, right? Because you put your home on the market as a rental, you can have it rented within a week and have it recorded in MLS as your rental price. But haven't really seen anything. Nothing.
Well, everything you're saying, Tina, I mean, it seems like for the investor, everything is good. Applications have gone up. The ones who are fixing and flipping, I mean, they can probably sell their house pretty quickly. And if they're buying and holding, well, rents are still pretty high. I mean,
it's not a good market to be an intro flipper, I would say. This is not a good time to learn how to do a flip property. This is probably a good time if you're experienced, really experienced, and know your market intimately. I would not start playing around with flip investing. At this point, this would be highly risky time to do it. But I think that people who have multiple avenues of leads for homes that they know are good because they intrinsically know their area very well, they'll do very well in this one. And the ones who can take on that little added risk if they're okay holding it for a little bit longer just so they can get the good deal now. Then,
so you're telling me so you're telling me if I were to choose between investing in real estate right now and I was new, I'd be better off probably learning to day trade?
I don't do day trading. I don't know.
Just saying.
Yeah, see, that's the thing. Well, see,
because
since
I just threw that out there because
you can lose your money forever in the stock market, it never comes back. At least with real estate, even if the house burns to the ground, the land's worth something. You don't ever go down to zero. So
True.
there's that part. But I'd still say that real estate investing is not for the faint of heart.
I was just playing because I've been learning day trading in the mornings. So
yeah, I was like,
where'd that come from?
I am not.
It was on my mind. It was on my mind. One that I should have taken this morning that I didn't. Anyway.
It is. It's really tough for investors right now, and I'll tell you this. You know, the way the response has gone to this pandemic has not really been nice to investors at all. In fact, the first thing that happened is say you do deed of trust investing or whatever, or now all of a sudden you've got people who can't make their mortgage. So that's not great for you. You don't get a government handout for that. Or say, for instance, you're a real estate agent and you've just, lost 4 or 5 deals in escrow, cancel. But you're like, hey, that's okay though, because I have my vacation rental that's helping me out. Oh, wait, that's gone now. I just lost my entire season for that. So then you're like, but that's okay. I can put it in with my long-term rentals, and maybe I could save myself there. But then the governor comes out and says, oh yeah, if you're a renter and you've got COVID, you can not pay your rent for 4 months and you can't be evicted. So yeah. It's been pretty tough, a very tough environment to be a real estate investor in this particular scenario. I think it's getting better, but like I said, it's not for the faint of heart.
Sure.
Good news is that a lot of the landlords and property managers that I've been on panels with and have talked to individually have found that the vast majority of their renters have been paying rent. So they had a big kind of influx of inquiries, but after these renters have kind of weighed all their options, come to find out, and most of them are choosing to pay their rent. And so and a lot of people are choosing to pay their mortgage as well. So I think that that's been a nice surprise.
It depends on what headlines you read.
Yes, right.
I saw a headline out there the other day. I don't remember where I saw it. Maybe it was on CNBC. and I think it had something to do with the prediction of up to half of renters not being able to make their full payment as of March or May 1st.
Mm-hmm.
But who knows? Who knows for sure?
Again, I've been on some panels lately over the last month and a half, and a lot of investor panels. And so I've learned a lot from those.
Yeah.
And what's real interesting is that, again, when we talk about having a strong foundation, I think we have had a very good, strong foundation in terms of wage growth here in Greater Phoenix, in terms of strong lending practices and so on, and also the government support for people to stay in their homes or keep their homes has been very strong, and they and offset some of these other negative pieces. It has been it's not how we expected to be tested, but I would say of all the tests, this was a good one. I mean, I think, and so far we're doing all right here in Greater Phoenix. I can't tell you where we're going to be in 6 months, but I'm on the more optimistic side right now, that we will recover. And that's the one thing about, that's the one stat I can tell you, 100% of every time we've had a recession, we have recovered 100% afterwards at some point, however long it took, but we recovered nonetheless. And so I do feel that we'll recover from this, and we'll be smarter, and we'll have learned some lessons about it as well.
Yeah,
and,
for sure.
Mm-hmm.
I'll send you this article because I'd like to, you can just respond back to me from it. But I did find it. It is from CNBC. I guess it's from 2 days ago. Only about half of Americans are confident they'll be able to make their full rent payment in May. So who knows?
Yeah,
I'll have to look closer to see who did the actual survey and all that. But
some of those. Yeah, we'll have to see. But again, here's the thing about the employment thing. It's real important to have the number of how many of these people are actually self-employed. And the reason why that's so important is that it gives us a insight as to how long we're going to be in this unemployment state. Because the fact is, if you're a hairstylist, or you're self-employed as a hair person, I forget what they call them, but you don't go get a job, you just go back to work. You know what I mean? And I can tell you, I'm probably not going to be able to see my girl for 3 months. She's going to be booked out solid. Same thing with nail technicians. You don't go find a job, you just go back to work. So that tells me that some of these numbers could go away as fast as they came.
Oh, sure.
If we have once people go back to singing, playing in the opera, or getting back to our basic services that are close up with people. And of course, obviously tourism and such, but that might be the one that lags the most. I don't know that everybody's going to all of a sudden leap on a plane and go somewhere after this. Right. But I do think that getting back to some of our basic normal things, like getting our hair done, getting our nails done, maybe a little bit of going out to eat, some of that stuff will start coming back, and that's going to help us out. Yeah.
Yeah. Last part that I want to talk about before we get into some of a couple quick questions, but millennials. One of the articles from that CCN place said these entitled millennials are cheering for a housing market crash. What are your thoughts about that? I mean, I can see where, younger adults probably would like to have the house prices come down a bit because then they can afford to buy, right? What do you think? Uh-oh, she's disagreeing.
That is, first of all, can I just say that I don't think millennials are entitled.
Oh, no, I'm not. Yeah,
I know, but I know that you weren't saying that. That was the headline, and I think that headline was kind of a clickbait thing.
Absolutely.
But the fact that, and I do know there are some people on the sidelines thinking, oh, great, maybe I can afford it. But the fact that they're even on the sidelines at all tells me that we're not anywhere close to that. Just all that has to happen is it becomes affordable to them. It doesn't need to be a bargain. Now, the thing in 2008, there was nobody on the sidelines. Again, our affordability was so low that Nobody could afford that. And they weren't even on the sidelines. They were too worried about putting food on their table, or how they were going to survive on a day in, day out basis. They weren't just gleefully waiting for prices to come down. The fact is once the price gets to where they can afford it, which we're already pretty high in affordability already, once it gets to a place where they can afford it, they're in. And that means we're not going to have a crash. Does that make sense?
Mm-hmm.
It's how long are you going to wait when you see each person get off the sidewalk and start buying? How long are you going to wait for prices to go down? And here's the other thing, let's just talk about that 5% decline. If they think prices are going to fall a whopping 5%, how much does that actually save on your mortgage payment? Like $50? You're going to wait to save $50 on your mortgage payment. If your interest rate goes up 0.5%, it costs you way more than $50 on your payment. So I think that oftentimes first-time home buyers focus too much on the price and not enough on the payment, because while they were waiting for prices to come down, payments declined for a year and a half while they were waiting. Even though the prices went up, that interest rate kept their mortgage payment so low, it was still, for the same house, it was the same price for principal and interest as it was in 2005, 15 years ago. And yet they're like, but I want the prices to come down 5%. What does that do for you? You know what I'm saying? It's not a logical, in real estate, it doesn't work that way.
Got it. Yeah. Anything else you want to make sure that any new headlines you've seen that, since we talked about this originally, or anything that's really jumping out?
Well, right now, a lot of the same, on the same site, we're seeing some surprised headlines, if you will. All of a sudden they're like, wow, mortgage applications jumped up. Well, this is going against everything we've been saying. And so those are kind of some fun headlines right now, because even on the same site, I can pull up headlines that say the crash is still coming. It's just going to take longer now, since we're recovering now. And then you've got another one that's like mortgage applications jumped up. So it just kind of tells me that if a headline doesn't match your personal situation, you don't pay any attention to it.
Right.
This is what happens on the street. You're a buyer and you haven't been able to find anything for, say, 6 months because it's been such a rapid move, market. Maybe you only had 3 houses you could look at. Now you have 10 and you actually like a couple. Are you going to sit at home in quarantine and watch that thing hit your feed every day?
Right.
You know what I'm saying? When that's a house that you want in the area you want and it looks like it's good, and then you want to go and smell it, and you find a realtor who will go show it to you, guess what? You're going to just sneak over there at one time. That's what happens.
Right.
So the more of this supply, we saw a nice little 31% increase in supply over a 6-week period. And some of that supply is really nice. And we're still seeing in some areas of town super hot activity. Gilbert, Chandler, South Phoenix, Laveen, Tolleson, West Valley, Moon Valley. All those areas still extremely hot. So I think that's what we're seeing is like some of these buyers are like, yay, I have stuff to look at.
Yeah, I was looking, agents that are listening or watching, the Crawford Report is a great resource, so you need to go check that out, get subscribed to it for sure. I was looking at the heat map the other day, or what you call the heat map. Mm-hmm. That's pretty fascinating to see the blue and the red and everything. I think the blue, the coldest market right now is out by Fountain Hills or something?
It's North Scottsdale, 85262.
No, oh, yeah, that's right.
Way up north, and Paradise Valley. They're both blue.
Paradise Valley, yeah.
That's a luxury market. And you can definitely see the color changes. And so what you're referring to is the chart that we measure what's active for sale versus what's under contract. So if you literally have more under contract than what's active for sale, we consider that to still be a frenzy market. And all those areas I just rattled off, still frenzy market, still more under contract than what's available for sale, despite the last 7 weeks of contract declines.
Wow.
If you're in Maryvale, they're writing just as many contracts every week in Maryvale as they were prior to this. So the main drops we've seen are all Northeast Valley.
Yeah.
Northeast, more expensive areas. Those are where we've seen the biggest pain points of this whole thing, and the least affected are areas like Pinal County, Southeast Valley, parts of the West Valley that are more expensive area. More affordable. So the more affordable the area, the less of an impact we've really seen. The more expensive, the more of an impact we've seen, because they do rely more on their portfolios.
Yeah. Oh yeah, I remember the blue. It was up northeast. Yeah.
Yeah.
All big blue area up there, but
yeah. Meanwhile, you got agents going, I don't know what everybody's talking about. I'm so busy down here in Chandler.
Oh, lots of red all over the place, though.
Yeah.
Absolutely. Well, thank you so much for being on here.
Yeah.
You got time for like 3 rapid fire questions, real quick?
Sure.
Okay, sweet. Let's get in the ring. How about a book recommendation while we're all kind of stuck at home?
Oh, I've only been reading the news.
News.
Who has time for books?
Favorite news outlet?
Oh, there you go. Favorite news outlet.
If it doesn't have anything to do with real estate, I'm not reading it. I'm like only looking at stats. Let me think. Who's good? I'm drawing a complete
Do you
blank.
have any favorite economists?
I really liked that guy that was talking about vacation rentals, and not just because I
Colombo.
agree with him.
Jesse
Yeah, his
Colombo.
name was let me look him up. He was the one on Forbes, Jesse Colombo.
Yeah.
I thought he had some really good points, and I'll be honest, when I first read his bio, I was like, oh, who's this guy? Another, sideline quarterback or whatever. And no, he actually did have some points that proved to me that he knows what he's talking about when it comes to housing. And so I generally look for people who have a good understanding of housing, who agree with me, of course. And I'm just joking. But I think that, some of these people that, like, some of these articles are written by people who predicted Bitcoin. Well, Bitcoin's not going to be like housing, or they're out of the country, like based out of India, one of them was. And I'm like, okay, so what ground knowledge do you have here other than just big data? So I tend to look at small data. I like small data better than big data. I like local stats better than national stats.
Right.
So those are the things I look for. I like to listen to, I read a lot of Housing Wire. I do enjoy their articles because I think lending is important. Lending does fuel a lot of housing.
All right. How about favorite genre of music?
I like heavy metal.
Really?
Yeah.
You have a favorite band?
I have a couple, but lately I've been following Pop Evil. Is one of my favorite ones right now.
Evil.
Never heard of it.
Yeah.
Oh, you're good. I think you like them. They're up and coming, but I like different genres of music. I have a wide variety, but I do love a good heavy metal concert. They're just full of energy.
Wow. Can you hear when you leave?
Huh?
Isn't it hard to hear when you get out of there?
Earplugs. I know. Listen to me, huh? I wear earplugs.
Have you, Joey? You used to listen to rap, didn't you?
I used to. Yeah, I'm. It changes.
Have you heard of NF?
No.
I guess he sounds a lot like Eminem, but minus all the bad words and stuff.
Really?
I like Eminem.
Yeah. Okay.
Yeah.
Well, I got a question for Tina. Tina, whenever we think about you, we think about numbers, we think about Cromford, but what do you like to do other than numbers and Cromford?
I like anything that forces my mind to focus on other things. So I like skiing because you have to focus in the moment. I like anything that brings me into the present moment, because so often my brain is on all these different tangents. So I like skiing, I like scuba diving, I like anything that forces that. I like physical activity.
Awesome.
Canyoneering is fun. Anything that really forces you to focus on what you're doing in the very present moment.
How about rodeos? I see a radio guy behind you there.
That is actually a joke. That was one of those pictures where you kind of Photoshop your face in.
Oh, got it.
And that's actually my boyfriend's. But yeah, so just kind of outdoors. I like outdoors activities.
So if everything was back to normal tomorrow,
Mm-hmm.
and you were planning a vacation, where would you go?
I think I might go. I would like to plan like a trip to Yellowstone or somewhere, just drive, be in nature. I've been in my house a long time.
Yeah.
Just anything outside right now, but I would love to see Yellowstone. There are a lot of the public parks that I have not been to in my life. So.
All right. Is there a certain restaurant that you've been dying to get over to?
Oh gosh, that's a good question. Well, I live in the Biltmore area, so a lot of the Biltmore restaurants I really enjoy, and I'm sad to see some of them have already closed, frankly, like they're done. But I like Hillstone is a good one for me, and gosh, there's so many I love Richardson's. That's another favorite. So yeah, those are just a couple.
Cool. Well, thank you so much for outlining some of this stuff too, and getting ready for this, because so many headlines out there. I know a lot of agents post a lot of things in these Facebook groups that I'm part of, and it just seems like half of them are it's going to be great, and half of them are here we go.
Well, and this is what I tell them, and I frankly I avoid almost every Facebook post. And I'll be honest, if there is any post that's in all caps or has more than one exclamation mark, I hide it. I'm like, this person's just ranting. This is not going to be a normal conversation. So I try not to get too involved in those. But I do read through. It gives me an idea of where people's heads are at.
Yeah.
But what I generally tell people during presentations that there is so much unknown. We've not been through anything like this before. So every week, more and more becomes known that was previously unknown. And at times like these, what we really need to do is place our emotions, recognize that we have emotions and we have PTSD of past crashes, right? Recognize we're all in some form of grief over a loss of some point of something, whether it's a loss of your goals, loss of your vacation plans, loss of a family member, loss of your security in health and finances, anything like that. We're all going through some form of grief, and everyone's in a different stage of it right now. But in times like these, what you need to lean into is what you know. What is definite? What are the things that you lean into the data? And so you can say, I'm afraid of a crash. What do the numbers tell me that today? Numbers don't tell me that today. I'm afraid of one, right? But we're not in a crash. So you have to bring yourself into the present, lean into what you know, lean into the data, trust it, which is hard for us emotionally sometimes, to actually trust the data.
Yeah.
So that's generally what my job is today, is to let people know where we are.
Yeah.
So they can go another week.
Well, and you're out there all over the place. So I know you have an event also tomorrow, I believe, on Friday.
Yes. So I'm really looking forward to that. It's another panel. I always learn more. I learn a lot on panels. And so we're going to be on a panel with an appraiser and a flip investor. Actually, he's an investor on many levels. He's done a lot of different types. And so me as an analyst, we're going to be discussing how what I do is different from what an appraiser does, and is certainly how it translates into investment decisions.
Got it.
So,
how can agents watch that? Or
I believe that is being hosted by Security Title. So you would contact any Security Title rep and get the link. Absolutely. Awesome. Well, thank you so much again for being on. And thank you, Security Title and Fidelity National Home Warranty, sponsors of the Weekly Closer. Until next time, agents, we will see you later.
Adios. Good job, guys. Good job.
Great job. Thank you.